Welcome to our deep dive on Roth versus traditional retirement accounts and how to build a smart, tax-advantaged savings plan that can exceed $30,000 per year when you combine workplace plans like the 401k with an IRA. First, we will set the stage with what each account actually does. Next, we will bust a common myth about so-called aggressive growth. Then, we will walk through an ultimate contribution flow favored by many financial planners. After that, we will compare Roth versus traditional using a pay now or pay later lens and show how to mix both for flexibility. We will also include a couple of quick quizzes to help you lock in the concepts. Finally, we will wrap up with key takeaways and an action plan. Here is our agenda. We will define tax-advantaged space. Then we will bust a myth about Roth IRA versus Roth 401k growth. After that, we will cover the recommended contribution flow. We will compare the pay now versus pay later tax decision. We will reinforce learning with diagrams and short quizzes. Finally, we will summarize with key takeaways and a clear next step checklist. With that in mind, let's move to a brief disclaimer before we begin. This content is educational and should not be considered tax, legal, or personalized investment advice. Everyone's situation is different, including income, employer plan features, state taxes, and goals. Before making decisions, consult a qualified financial or tax professional. Now that expectations are set, let's begin by busting a popular myth. A common misconception is that a Roth IRA provides more aggressive growth than a Roth 401k. In reality, growth depends on the investments you choose, not the type of account. Both IRAs and 401 kiloseconds usually offer a spectrum of aggressive to conservative funds. Some IRAs may offer more choices or lower fees, but the account label itself does not increase expected returns. With that clarified, let us lay out an efficient way to allocate contributions across accounts. The truth is that the expected growth rate comes from your asset allocation and the underlying investments. A Roth 401k and a Roth IRA are both Roth vehicles funded with after-tax dollars, and both allow tax-free qualified withdrawals. What can differ are administrative fees, the breadth of available funds, and certain plan conveniences or employer features. The action tip is to select a diversified, low-cost portfolio that matches your risk tolerance and time horizon, independent of whether you are in a Roth IRA or Roth 401k. Next, let us walk through the ultimate contribution flow that many experts recommend. This flowchart shows a three-step priority list. Step 1 is to contribute to your traditional 401k up to the employer match because that is effectively a guaranteed return and gives you an immediate tax deduction. Step 2 is to max out a Roth IRA, which often has broader investment choices and potentially lower fees. Step 3 is to return to the 401k and contribute the remainder. At this step, use a tax bracket decision. If you are currently in a lower tax bracket relative to what you expect in retirement, prefer Roth 401k for after-tax contributions now and tax-free withdrawals later. If you are in a higher tax bracket today, prefer traditional 401k to reduce taxes now. The diagram also reminds you that an employer match is generally pre-tax and does not count against your Roth or traditional designation, and your combined tax-advantaged space can exceed roughly $30,000 depending on the tax year. With the big picture in place, let us break this into actionable steps. Step 1 is to contribute to your 401k up to the employer match. This is because matching contributions are essentially free compensation you would otherwise leave on the table. Step 2 is to contribute to a Roth IRA up to the annual limit. Many investors appreciate the fund variety and straightforward fee structure these accounts offer. Step 3 is to return to your 401k and continue contributing until you reach the annual maximum. Here, choose between traditional and Roth contributions, depending on your current and expected future tax brackets. Now that you understand the order of operations, let us examine the core trade-off of paying taxes now versus paying later. If you are currently in a low tax bracket, such as 10 or 12%, favor Roth contributions, because paying taxes now at a low rate can be highly advantageous, and future qualified withdrawals are tax-free. If you are currently in a higher tax bracket, favor traditional contributions, because the immediate tax deduction can be more valuable today, and you can plan withdrawals later, potentially at lower tax rates. Over the long term, a thoughtful mix of both Roth and traditional funds gives you flexibility. In retirement, you can pull from Roth or pre-tax sources to manage your taxable income and aim to remain in a favorable bracket. To visualize how this can change over a career, let us look at a timeline. This timeline illustrates a typical arc. In early career, income may be lower, making Roth contributions appealing because you lock in taxes at a lower rate. In mid-career, earnings often rise, making traditional contributions more attractive as a way to reduce current taxes. In late career, many people choose a blend in order to diversify tax exposure. In retirement, the goal is to draw from both Roth and traditional pools strategically to manage your taxable income. Pre-tax accounts are typically subject to required minimum distributions under current law, whereas Roth sources are generally used flexibly. Exact rules can change, so always verify the current regulations and consult a professional. Next, let us compare the two account types side by side. On the Roth side, you pay taxes up front and qualified withdrawals are tax-free. This is often attractive when your current tax bracket is low and as part of a broader tax diversification plan. Direct Roth IRA contributions can be limited by income, though workarounds may exist. Verify what is permissible for you. On the traditional side, you defer taxes and receive an immediate deduction today, which can be valuable in a high bracket. Withdrawals in retirement are taxed as ordinary income. Employer plans typically allow traditional contributions regardless of income. With this comparison in mind, let us ground things with contribution limits and an illustrative combined target. This table shows example figures consistent with recent IRS guidance. A common structure is a $23,000 employee 401k limit plus an additional $7,000 for an IRA, creating roughly $30,000 of annual tax advantage space before any employer match. For those age 50 or older, catch-up contributions can increase these amounts. Limits change and vary by year, and employer features differ, so confirm current IRS numbers and plan specifics. These figures also explain the 30,000 plus framing for this discussion. Now, to reinforce the idea of diversification, let us visualize a target mix by retirement. This pie chart shows a hypothetical mix in retirement with 60% in pre-tax or traditional accounts, 35% in Roth, and 5% in taxable. The exact mix will vary based on your earnings, savings rate, plan options, and tax strategy over the years. The purpose is to emphasize the value of having both Roth and traditional sources when you are planning withdrawals. With the visuals in mind, let us test your understanding with a quick quiz. Question: which statement is most accurate about growth in a Roth IRA versus a Roth 401k? Option A: Roth IRA grows faster by design. Option B: Roth 401k grows faster by design. Option C: growth depends on the investments, not the account type. Option D: neither account can hold aggressive investments. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Growth depends on the investments, not the account type. The label Roth IRA or Roth 401k does not inherently change expected returns. Your asset allocation and fund choices do. Now, let us take a second quiz on the optimal contribution flow. Question: according to the recommended priority, which order is generally best? Option A: max Roth IRA, then 401k match, then 401k remainder. Option B: 401k to employer match, then max Roth IRA, then 401k remainder. Option C: 401k remainder first, then Roth IRA, then match. Option D: only Roth contributions everywhere. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. First, contribute to your 401k up to the employer match, then max out a Roth IRA, and finally return to the 401k to contribute the remainder using either traditional or Roth depending on your tax situation. With the quizzes complete, let us consolidate the main takeaways. Key points: investment growth depends on the underlying portfolio, not whether the account is a Roth IRA or Roth 401k. Follow the three-step priority flow of match, Roth IRA, and then 401k remainder. Favor Roth when your current tax rate is low, and traditional when your current tax rate is high. Maintain a mix of both to manage your retirement tax bracket. Always confirm the latest IRS limits and your plan's details. Now, let us translate this into a concise action plan you can use this year. Here is your action plan. Set automatic contributions to your 401k to capture the full employer match. Open or fund a Roth IRA and aim to reach the annual maximum. Decide how to allocate the remainder of your 401k contributions based on your tax bracket, favoring traditional when taxes are high and Roth when taxes are low. Revisit your plan each year as your income, tax situation, and goals evolve. Keep fees low and maintain a diversified portfolio. Finally, verify current year IRS limits and your employer plan's rules to ensure you are contributing efficiently. To close us out, here is a quick message. Thank you for watching. If this breakdown clarified the Roth versus traditional decision and the contribution flow, please like the video, share it with someone planning for retirement, and subscribe for more evidence-based money guides. Add your questions and your own Roth versus traditional strategy in the comments so the community can learn together. See you in the next video.